Hi, my name is Jeff Bullock with Elevation Tax, and I'm excited to be with you today as part of the Cash Flow Wealth Summit with Paradigm Life. Now I'm sure you're all thinking, oh great, how good can this be? We've got a CPA talking about taxes, and I hate taxes. Good news, I hate taxes as well. And I'd even venture to say, I probably hate them more than you do. But before we get started, I'd like to take a second to give you a little background about myself and our firm. I began my career as a staff accountant with PricewaterhouseCoopers in Denver, Colorado. Now when I started there, I couldn't wait. I thought I'd be spending my days slaying the tax dragon and saving clients tens of thousands of dollars a year in taxes. They would be ecstatic. Boy, was I wrong. After getting settled in, I found myself spending months and months at a time working on a single line of a tax return. This is definitely not what I had envisioned as being a tax accountant. After spending close to 3 years like this, I decided there had to be a better way. PricewaterhouseCoopers, like many other traditional accounting firms, were simply there for compliance. Tax returns have to be filed, and so these firms exist simply to file these tax returns, regardless of the outcome. Some of you today may be nodding your heads in agreement thinking, yeah, I have that tax man. All he does is file my tax returns at the end of the year. Nothing else. After seeing this, I was determined to start my own firm that focused on tax planning and tax savings, and that the tax returns were simply a formality that confirmed our tax planning had been done correctly. Now fast forward to today. Here at Elevation Tax, we've helped thousands of clients across the country not only reduce taxes, but in many cases, completely eliminate them. Our approach is simple. We find ways to permanently reduce taxes and not simply delay them to some future date. Permanent tax savings and not temporary band-aids. While we might agree that taxes aren't that sexy, they are, however, the number one thing that prevents people from growing their wealth. So I do think they deserve just a little bit of attention. Now, there's a myriad of different tax topics that we could discuss, but today I'd like to focus our attention on one of the most common questions that we get as a firm. And that question is, if you could pick one single vehicle for investing, what would that vehicle be and why? Now, rather than give you a boring slideshow with a bunch of bullet points that no one will ever remember, I've decided that I'd like to tell you a story of one of our clients. And that client's name is Bob. Bob is a middle-class American with some money in his savings account and a little tucked away for retirement. He's got a good paying job and he feels he's doing all right, but he just doesn't seem to be financially getting ahead. He remembers talking to advisors and knowing where he should be at this point, but for whatever reason he feels like he's fallen behind or lagging and his retirement will never be in the position where he hopes it to be. He provides for his family and is able to have fun, but never seems to be building that elusive nest egg. He decides to spend the afternoon with his financial advisor, Jeff, and that's me, looking for some advice on how he should be investing his money. During our conversation, we discussed a myriad of subjects, but there are three that stuck out in particular to Bob. The three things that really stuck out to Bob are, first, that taxes will absolutely destroy traditional investments. Bob had heard a lot of things about these types of investments and thought they would be a great vehicle for some of his liquid cash. But during his conversation with Jeff, he found out that might not be the case. Second, his 401k at work, it was simply a ticking time bomb. Now Bob, that took him a little bit by surprise because he had always thought the 401k is the way to go. That's my main vehicle for retirement. Aside from Social Security, which hopefully is there, my 401k is going to be what takes me through retirement. So when he found out that it was this ticking time bomb, he wasn't sure what to do. The third thing he found out is that by investing in real estate, he could actually reduce and in many cases eliminate his taxes completely. Now, Bob had always heard about people that invested in real estate and thought that this wasn't for him or didn't know how to do it and didn't understand any of the benefits from it. But after his conversation with Jeff, he left the meeting thinking, I need to get into real estate and I need to do it as soon as possible. To start our discussion, Bob said that he had $100,000 cash that he wasn't sure what he wanted to do with. Rather than jumping straight to my solution, I asked Bob what he thought he was thinking about doing with the cash. He said that he was debating between two options. First, he found a CD at his local bank that was offering a 10% rate of return. That seemed like a great investment, but it did have a few limitations. He wouldn't be able to access the funds without a penalty, and it would be tied up for a number of years. The second option that he found was actually a savings account offering a very competitive rate of 8% interest. A few things that he liked about this was that the funds would be liquid, that he could access at any time, and it would actually grow over time. Seemed like a better place than sitting under the mattress where it was right now. I did agree with that under the mattress was not a good place for the investment. But I did want to show him what the true ramifications or the true outcome would be if he was to take this $100,000 and invest it into a savings account. So the first thing I did was ran a projected cash flow or ending balance of his $100,000. So we took the 25 years, we took the initial investment of $100,000 with an 8% rate of return and plugged that into our calculator. After 25 years, his total investment will grow to $684,848. Not too bad for a savings account investment. Looking at that, Bob wanted to jump on it right away. However, I asked Bob if he knew any of the other ramifications of this investment. He didn't know, so I said, okay, let's look at it beyond just the actual rate of return. So we run the same scenario, but this time I asked Bob, what tax bracket are you in? And he was in the 25% tax bracket. He said, oh, I didn't think I'd have to pay taxes on this since it was just sitting in a savings account. But because it's in this liquid account, he actually does have to pay taxes on it year after year on any growth that's happening within this account. So after we take into account the actual taxes from this investment, you see that the total value goes from the $684,000 clear down to $429,000. So a total loss in his account of over $250,000 throughout that 25 years. That's a 37% drop in account value from year 1 to year 25. So while it may seem like this is a great place to put the money, when you look at the actual numbers, you find out this might not actually be the best place, and his actual rate of return on this after taxes was only 6%. So with that tax hit, the drop in value, this investment didn't seem quite as enticing as it did initially. Now, before I gave Bob my thoughts on what I thought he should do with this money, I asked him if there was anything else he was currently doing to help build his wealth. With a big old smile, he said, absolutely, Jeff, and you will love this one. I'm making contributions to my 401k each year at work. I know you'll like it because it's all tax deductible, so I don't have to pay any taxes on it. Now, before bursting his bubble, I thought I'd ask him why he thought this was such a great option. So he walked me through the advantages that he saw and that his prior advisor had told him about investing into a 401k through his employment. So the first thing he told me was these contributions are tax deductible. Everything that I put in there now, I get a write-off on my taxes in the current year. And he was correct. So if he made a $10,000 investment, he would be able to reduce his taxable income in that current year by $10,000. He saw a huge advantage to this. The next thing was he said, I'll have more cash in my pocket today. If I make that $10,000 investment, that means my taxable income's down, and that means that I have more cash to go spend. Whether it's on a vacation, buying new cars, whatever it is, he's got more cash in his pocket today. The third thing that he said, and this was from his advisor, is he said, when I retire, I'm going to be in a lower tax bracket. There's no question I'll be in a lower tax bracket. I'm not going to have my income coming in, less income, no W-2. I'm just going to have retirement funds. And so I'm definitely going to be in a lower tax bracket than where I am today. The fourth thing that he talked about was his company match. He said, hey, I get a 50% match for every dollar that I contribute. So a 50 cents on the dollar contribution match. So I'm going to put in $10,000 and they'll actually match it $5,000. So I want to do this because I get free money. And that's a common thing that I hear from clients is I want to put money in there because it's matched by my employer. And then the last thing he said was that his prior advisor told him this is the quickest and most efficient way to build your retirement nest egg. So when you retire, you've got something there. Now, rather than poking a bunch of holes through the advantages that he had just laid out, I decided to, rather than doing that I would actually walk him through an example of exactly what was happening with this and be able to show him that all of these things that he had learned were simply band-aids for the inevitable tax that was going to come. So none of these things were actually preventing tax from being owed down the road, but were simply there to help delay that tax coming. So I like to call these the tax band-aids. They don't fix anything, they just cover it up for a little bit. Rather than poking a bunch of holes through Bob's assessment, I figured that it would be best if we just looked at his actual situation and walked through the numbers. So each year, Bob let me know that he invests $10,000 into his 401k. There's an 8% rate of return, and he's planning to retire in about 35 years. So we took the numbers, plugged them into our trusty calculator, and found out that after 35 years, his retirement account will be worth $1.8 million. Not too bad for a nest egg to retire on. However, the one thing that Bob wasn't taking into consideration were the actual taxes that were going to be due. Because of that quote-unquote benefit back when he was making the contributions throughout the years, all it was doing was pushing out what he was actually going to owe in taxes by the time he retired. So we took that same value at retirement of $1.8 million and we assumed his tax rate. In this case, he was currently in the 25% bracket. And for comparative purposes, I said, let's just assume you're going to be in the 25% bracket. We'll get into that a little bit in just a minute, but we'll see what that will do to your nest egg. And with a 25% bracket tax on the $1.8 million investment, Bob will end up paying almost $500,000 in taxes. Now that's a tremendous hit to his retirement account, and one that frankly he wasn't even thinking about. He assumed that he would be in a 10% bracket or a 0% bracket, but we'll show you shortly that chances are he might actually be in a higher bracket than he's currently in. But for this, all intents and purposes, for this example, we can see here that even at just the 25% bracket, he's going to be spending almost $500,000 in taxes. Now, aside from the huge tax liability that we just saw as being created, there are some additional restrictions that I think are worth mentioning about these qualified retirement accounts. So before you go putting all of your money in there, stop!
let's have a look and see what some of these restrictions might be. If you remember, Bob had $100,000. Now let's say that Bob wants to take that $100,000 and put it into this 401k or an IRA, any qualified retirement account. The problem with this is that there are contribution limits on all of these plans. So that $100,000 that Bob wants to invest into one of these plans, it would actually take anywhere between 5, 10, and even 15 years to truly get all of that $100,000 into one of these qualified accounts because of the contribution limits. So the first restriction is you're limited on how much and when you can make these contributions. The next thing, which will inevitably happen throughout life, is things will arise. For example, medical bills. You may have an unforeseen illness, car accident, medical emergency, whatever it might be, where you need to access funds. The second thing is you may want funds for a vacation. You may say, you know what, we need to take that once in a lifetime trip around the world and it's going to cost us $30,000. And if you go into your retirement account, you're going to be hit with some major penalties. The next thing is, what if you wanted to use these funds for schooling, or maybe you've got taxes due, heaven forbid. You've got a large tax bill that you've got to pay. The problem with this is most likely going to be your biggest asset that you're sitting on, but it's also the one asset that you're not going to have access to. So the accessibility of your funds are going to be extremely limited with this account. And if you do decide to take them out, the penalty that you're going to pay to take that out in some cases will more than double the tax that you have to pay. So there could be times where you take the money out and more than 50% of what you've taken out has been taken away through penalty and tax. Now the third thing, and this is a very popular one that investment advisors will give, and in Bob's case, his investment advisor told him that when you retire, you're going to be in a lower income tax bracket than you are today. So let me just paint this picture for you. Right here you've got a chart or a graph that shows from the inception of income tax all the way through today, 2016. It shows exactly what the average maximum rate and the average minimum income tax rates were. Now the minimums have stayed pretty constant. What hasn't stayed constant is the maximum rate. And you can see for a good chunk of time, the maximum rate was 60, 70, 80%. The average maximum tax rate between 1913 and 2016 is almost 60%. So I know a lot of you are thinking, and I know I've thought this in the past, that there is no way taxes can go up from where they are today. The highest marginal tax bracket is almost 40%. It wouldn't make sense if the government was to come in and tax us even more. Well, think about this. Are we in a better position than we were 20 years ago? Is our debt less? No. The country's got almost $20 trillion in debt. We're having issues with Social Security, Medicare, Medicaid. None of these programs are sustainable. Yet people assume that taxes are going to go down in the future, when in reality, the only thing that they can do is go up. This is the only means that the U.S. government has to raise funds. And if they've got all of these programs, Obamacare just came out. Just this week, we find out that Obamacare premiums are now going to go up 25 to 50% of where they were last year. Well, part of that is being subsidized by the government. And how are they paying for it? With our taxes. So when somebody tells you that when you retire, you're going to be in a lower income tax bracket than where you are now, I would be very hesitant to believe that advice. The second part of that, right now, when you look at your tax return, you'll notice that you've got some major tax deductions that by the time you retire are most likely going to disappear. First, you've got kids. I hope by the time you retire, the kids are moved out and they're no longer on your tax return. And the second one is going to be your home interest deduction. Hopefully by the time you retire, the home is paid for and you no longer have that deduction. But between the home interest as well as your kids and a number of other deductions, most likely you're no longer going to have all of the deductions that you have today that help drive down your taxable income. So in Bob's case, this was quite an eye-opener that he was able to see, wow, I really might not be in a lower tax bracket. If he's in the 25% bracket now, you can see that that is well below the average. It's closer to the minimum tax rate that we've had throughout our country. So the unknown future tax rates, just know that that could be an area where taxes will be going up in the future. Now the fourth thing we talked about was what he was actually investing in his 401k account. And like most of you, he was invested in the stock market, in bonds, stocks, different notes like that were tradable securities. Well, one of the biggest benefits of actually trading stocks and bonds and other securities in the market is they're considered capital assets, and therefore they'll get preferential tax treatment. So normally if you were to buy a stock, you hold it for more than a year, and then you sell it, you can get, instead of paying ordinary tax rate, so in Bob's case 25%, you can actually pay 15%. If your income's really high, it'll be 20%, or if you're in the 15 or 10% bracket, it'll actually be 0%. The one problem with this is that when your funds are inside of a retirement account, or when your securities are held in a retirement account, you don't get to take advantage of any of these preferential tax brackets. So when you retire and actually withdraw these funds, you buy and sell those securities in your account. The account's not being taxed until you take the money out, and that money will always come out at your ordinary tax bracket. And therefore, you're missing out on these favorable tax rates. And so within the 401k, you don't have any sort of favorable rates that you would have outside of a 401k. And the last thing was the taxes. So we went through all this work to put this money aside to avoid taxes, and in the end, we didn't save anything on taxes. Chances are we're going to end up paying more in taxes simply because we'll be in a higher tax bracket when we retire. So the primary driver of putting money into this account would be to reduce taxes. And if we really look at it and flip it around, in reality, we haven't only prevented taxes, but in many cases, we've actually increased the taxes. And so the last thing is that these qualified plans, they simply defer the taxes to a future date with a lot of unknowns for us. And so one thing that I tell clients, and I told Bob, is that this is usually a lazy advisor's favorite tax planning tool. Now that might sound a little harsh because you've probably heard it from quite a few people, but this is the easiest thing for them to tell you at year end. Hey, you want to save some money on taxes? Put it into a qualified plan. Max out your IRA. Put it into your 401k. It's fantastic. Reduce your taxes. You don't have to worry about it until you retire. Well, when you retire, they're going to be long gone, and you're going to be the one stuck holding the bill. So be careful what advice you take from these advisors. As you can imagine, by this point, Bob was feeling frustrated. He had no idea what he should do or where he should put his money. So we had talked about a couple different things. We talked about the traditional investments, and those were limited options. You couldn't avoid taxes on those, and the tax hit was pretty significant. We had discussed the qualified retirement plans where he had been putting the majority of his money up to this point. However, we found out that all of these things, all of these benefits were simply band-aids, that none of them were truly going to permanently reduce his taxes, but they were simply just delaying the tax man who would inevitably come. So both of these, we had to just reject them. These were not the way to go to actually build wealth. I said, okay, Bob, I know you're feeling sad. I know you're feeling depressed, like there's nothing we can do. Give me 5 more minutes, and I think we can find a good solution for you. So I said, all right, what if we can find an investment, number one, that permanently will eliminate your taxes? So with your 401k, all we were doing was deferring the taxes, and in most cases, I'd argue that we were actually increasing your taxes by deferring them. The next thing that we can do is we can actually generate you tax-free cash flow. So not only are we going to avoid taxes on your investment, but you can generate cash flow that you don't even have to pay taxes on. I'm seeing a change in his eyes. He's starting to think, wow, could this be too good to be true? I said, okay, one of the things you talked about that we haven't discussed yet was your company match. The 401k, they give you 50 cents on the dollar for your contributions into the 401k. Well, what if I tell you we've got an investment that will give you a 400% match on your contributions? So if you put in $1, they're going to put in $4. Now, Bob said, now this just seems like one of those too good to be true. You know, am I talking to Bernie Madoff here? Like, what are we talking about? I said, hold on, we'll get to it. The next thing is there are no investment limitations. So if you remember with the 401k, you're not in control of how much you can invest in there. There's contribution limitations. There's times that they tell you have to take the money out, the required minimum distributions when you turn 70 and a half. They force you to take money out of those accounts. With this investment, there's actually zero limitation. You can put as much money into it as you want. You can take it out when you want. And that gets to the final benefit of this, is that there's liquidity to it. That meaning at any time when you've got those emergency expenses, or maybe not so emergency expenses that come up, you know, there's that brand new Ford Raptor that just came out that you want to purchase. Well, you've now got a vehicle that you can actually tap into without even selling or creating a tax ramification for taking those funds out. By this point, as you can imagine, Bob's eyes are ginormous. He's like, okay, just tell me what this is. I said, all right, Bob, you know what it is? It's a unicorn. Yeah, I got a good chuckle from Bob with this. And I said, okay, all joking aside, Bob, it's probably what you would least expect. And it's what you're living in today. It's rental real estate. And he said, rental real estate? I just hear people lose money on rental real estate. How could that be this magnificent investment that you just explained to me? I said, well, let's walk through the numbers. Let's look through an example, and I can show you exactly what you could do or what your investment could do if it was invested correctly into rental real estate. So the easiest way to show Bob exactly how he could benefit from this rental real estate was to walk him through an actual example. So we laid out the numbers, and I said, all right, let's assume that we purchase a property for $300,000. With that, you're most likely going to have to put a 20% down payment down. He has the $100,000, so we take $60,000 of this and put that down as his down payment. So that's his investment. As you can see, with the purchase price of $300,000, the other match, that 400% match, is actually coming from the bank. So he's willing to put 20% down. The bank's willing to put the other 80% down. The benefit of this is that you are benefiting 100% of what the bank is putting in. So Bob is able to leverage his money significantly with this investment. Now, the investment itself, let's say that it generates $2,000 a month in rental income, so $24,000 a year. Because he's carrying a mortgage of $240,000, his monthly interest, and this is about 5%, is about $12,000 a year. He has about $3,000 in property taxes, insurance. He's got some utilities and some repairs. So when all is said and done, his total expenses on this property would be $18,000. So he's got rental income of $24,000, total expenses of $18,000, which gets him to a pre-tax profit of $6,000. Now, I said that this money was tax-free, but initially, just because it's real estate doesn't mean that it's tax-free. There's some things that we can do that will create that tax-free benefit, but right now you can see that he's got a pre-tax profit of $6,000. So if this is where we stood at year end, at a 25% tax bracket, Bob would be paying $1,500 in taxes, which still leaves him with a net profit of $4,500, which is not too bad for a $60,000 investment. So we can see that this investment, the first thing is that it actually generated us a positive cash flow of $6,000. So that was our cash in, which was the $24,000 minus all of our expenses, which gives us the profit of $6,000. So annual cash flow of $6,000. It did require us to pay $1,500 in taxes, which netted us a profit of $4,500, which when divided by our down payment of $60,000 gives us a 7.5% rate of return after tax. When compared to his other investments, if we were to look at the first investment that he invested in the savings account, got 8%, but when taxes were paid, it was actually 6% after tax. And then his 401k, or his qualified retirement account, we didn't actually, his tax on that was 25%. And so his true rate of return on that was also 6%, and not that 8% that he assumed that he was getting in the account. Now if we were just to stop now, this is a great solid investment. However, this is just the surface. When we talk about rental real estate, there's something called depreciation. And this is one of my favorite things about real estate and about the tax code. And what depreciation is actually a reduction in the value of an asset with the passage of time due to wear and tear. So picture you go and you purchase a car. Over time, that car is going to lose value simply due to the wear and tear on it. You drive 100,000 miles, and it's going to be in worse shape than it was when you bought it, day one versus year 5 with 100,000 miles. It's losing value, and so what the IRS says is you can write off an expense of that. Over time, we'll let you expense that to nothing. Well, they'll let you do the same thing when it comes to rental real estate. But if you think about it, when you purchase a home, does it go down in value? No, it actually goes up in value over time. So while you're able to write off this expense or this investment, it's actually increasing in value. So you can see that real estate normally goes up in value, but you're still allowed to take the deduction and reduce that value for tax purposes. The second thing is you can actually take depreciation on borrowed money. So in this case, we went to the bank and got a loan for $240,000. The IRS is still letting us write off that as a depreciation expense, where normally the only thing you're able to write off is what your cash outlay. So in this case, it would have been that 20% down payment, that $60,000. But when it comes to real estate, they say, no, you can take the full investment, the full $300,000, and depreciate that and write that off. And the last thing is that no cash actually leaves your pocket for this expense, that it's a paper loss only. So sometimes you'll hear paper loss, and that simply means that you take the loss for taxes, but no cash actually came out of your pocket. So you don't have to turn around and just because it's technically or quote unquote losing value, you're not actually paying a penny out of your pocket to get that tax benefit. So let's go back and look at our same example where we've got the purchase price of $300, all of our expenses, and now what we're able to do is take into account depreciation. So we take the home, the IRS tells us how quickly we can write that expense off, and in this case, if we took straight line depreciation, we would get $8,727 of additional expense that didn't actually leave our pocket, but that we were able to use and utilize against the income that was generated. And if we do that, you can actually see we've got a pre-tax loss instead of gain now of $2,727. And if we're still in the 25% tax bracket and we've got other income that we can offset with this loss, we've now just generated ourselves, instead of paying $1,500 in taxes, we've now generated ourselves a tax refund of $682. And this was simply by including the depreciation in our tax calculation. I can't tell you the number of times where I have taken somebody's tax return from the prior year that has rental real estate, and for whatever reason, sometimes it's self-prepared, sometimes it's a professional that prepares it, but they're not taking depreciation into account. They're simply saying, oh, eventually when you sell the property, it's going to come back as a gain, so it's not worth depreciating that. And it just makes me laugh, and I just wonder, what other bad advice have they been given if something is as big as this is being left off of the tax return. So the benefits now that we see once we take into account depreciation, the first one is our annual cash flow is now at $6,682. We generated that $682 refund, so no longer have that expense, and that now takes our after-tax rate of return to 11.1%. So even with the first investment without depreciation at 7.5, by taking into account depreciation, which cost us nothing, we're able to increase our rate of return by almost 4% from where we were before. All right, so Bob was liking what he was seeing, but now he said, okay, Jeff, these numbers look great. This could be a great investment, but what do I do when I want to sell it, when I want to retire and actually take this money and live off of? What is it going to look like tax-wise from there? I said, Bob, that's a great question. Let's take a look. So one of the beauties of real estate is similar to a security, like a stock or a bond, it's considered a capital asset, and so therefore it receives preferential tax rates. With your securities that were held in the 401k, we saw that you didn't actually get any benefit of holding capital assets in those 401ks. And it's pretty ironic how probably 95% of people that have 401ks or IRAs hold stocks and bonds in there. And so the one benefit of those stocks and bonds are being wiped out because of the vehicle that they're held in. So with real estate, the beauty of it, it's a capital asset, and therefore when you turn around and sell it, you're getting these preferential tax rates. So the possible tax brackets that you'd be in is the 20%, 15%, or 0%. Most people will be in the 15% bracket, and so for this example, for Bob, that's where he was at a 25% tax bracket. It would give him a 15% capital gains rate. So we took a look at his scenario. He said, I've got somebody that's willing to purchase it for $400,000. There's going to be some selling expenses, realtor fees of about $25,000. And then we've got an adjusted basis of $256,000. Now that adjusted basis is what we purchased the property for, so the $300,000 minus the depreciation that we've taken. So because the IRS is allowing us to write off that depreciation each year, when we turn around and figure out what the gain is, we have to use what the depreciated value or the adjusted basis is. So in Bob's case, it's $256,000. So if we take the sales price, we minus the selling expenses, and minus the adjusted basis, we get a taxable gain of $118,636. The beauty of this is it's not taxed at his ordinary rate. So if he's in the 25% bracket, we're only having to tax this at 15%. So Bob now is actually saving on taxes. So by investing in this real estate, he has permanently reduced himself from the gains on this, from the 25% ordinary bracket he was in to the 15%. Now, we're looking at the scenario if Bob actually sells the property. There are some things that we can do with real estate where Bob will literally not have to pay a single penny in income tax if he wanted to. Right now, we don't have time to get into all of that, but we would love to answer any questions or help anybody who's in a situation where they want to know if there's additional things they can do with their real estate. For Bob, he said, are there any other benefits of holding this real estate? And like I said, there are. So the first one that we talked about was that 400% match. So most banks only require 20% down, sometimes even less. We've got clients that have relationships with banks, have multiple properties, and they're able to negotiate and only have, let's say, 10% down. So that match essentially allows you to get into this investment that you can take full advantage of. The second thing is the liquidity. We haven't got into a lot of detail about this, but if something were to happen, you can actually go and take money, take the equity that your property has gained from owning it. So both paying down the principal as well as just the increased value, you can go and tap into those funds. So if you had a medical emergency, needed to pay for college, you can actually take those funds out of the property, still own the property, so you don't have to turn around and sell it, so there's no taxable event, and now you've just got a second loan on the property that you'd still have to pay back, but it hasn't caused any taxable event to occur. The third thing is there's something called cost segregation. So this is, think of depreciation and put it on steroids. So you saw from earlier how beneficial depreciation can be. Well, with cost segregation, what we're able to do is accelerate that depreciation even more. So in Bob's example, we could get 2 or 3 times the amount of depreciation. So this is an incredible tax planning tool that you can use on a case-by-case basis, property by property, based on your own personal tax situation. And then the last thing is you truly can make real estate 100% tax-free. And the way you would do this is there's what's called a basis step up upon death. So if you held this property and you took, let's say you still wanted to take the money out to live off of, you could do all of that like we talked about above with liquidity. And then what happens if you were to pass this on to your heirs, on the day that you die, instead of having that adjusted basis that we saw in this example was $256,000, the date of your death, the basis of this property automatically jumps up to the value of the property on the day that you pass away. So it could pass away to your heirs. They could turn around and sell it the next day for absolutely no income tax. So these are just some of the additional benefits from owning real estate. Like I said, we don't have time to get into all the nitty-gritties of it, but we would love to answer any questions, big or small, regarding real estate. If you're a seasoned real estate investor or maybe just thinking about testing the waters, give us a call. We'll walk you through, we'll answer questions. And as a special thank you for participating in the Cash Flow Wealth Summit, we have put together a short PDF that outlines what we believe to be the 5 biggest tax mistakes real estate investors make. Please download your free copy here. Also, if you have any additional questions or would like to schedule a free consultation, please give us a call at 888-519-1666 or visit our website at elevationtax.com. Thanks for watching.